So, in 1933, the US government did something unprecedented. It declared it illegal for private citizens to own most forms of gold, forcing them to sell it to the government for a fixed price. The move was justified as a national emergency, a way to save a crippled economy. But just a year later, after collecting the nation's gold, the government revalued it, and its own wealth skyrocketed off the very assets it had taken from its people. Now, let's look at today. The US government has quietly become one of the largest Bitcoin holders on the planet. Through years of seizures and forfeitures, its digital wallet has swelled to contain hundreds of thousands of Bitcoin. They took the gold then, and if you think they don't see the strategic value in Bitcoin now, you haven't been paying attention. The old playbook is lying open on the table, and a new version of the game has already begun. In this video, we're going to break down the shocking historical parallels that every crypto holder needs to see. We'll dissect the 1933 gold seizure, reveal the government's rapidly growing Bitcoin stash, and explore what this could mean for the future of your digital assets. This isn't just a story about the past, it's a warning for the future.
To understand where we might be heading, you have to know where we've been. Her story starts not in the digital age, but in the depths of the Great Depression. It's 1933, the American economy is on its knees. The 1929 stock market crash wiped out fortunes, and the years that followed were a cascade of failures. Confidence wasn't just low, it was gone. People were terrified. And when they're terrified, they don't run to paper money printed by a struggling government. They run to the oldest store of value on Earth, gold. This created a huge problem for President Franklin Roosevelt. The U.S. was on the gold standard, meaning the amount of money the government could print was tied to the gold it held. By law, the Federal Reserve had to hold gold equal to 40% of the value of the currency it issued. But as panic spread, people were pulling their gold out of the banks. This hoarding, as the government called it, was strangling the Fed's ability to inflate the money supply, which Roosevelt saw as essential to restart the economy and fund his New Deal programs. So on April 5, 1933, FDR dropped a bombshell. Citing a national emergency, he issued Executive Order 6102. The order was brutally simple. It forbade the hoarding of gold coin, gold bullion, and gold certificates. Every American citizen was required to deliver almost all of their gold to the Federal Reserve by May 1, 1933. You could keep a small amount, about $100 worth, and certain rare collectible coins, but the rest had to be surrendered. The penalty for defiance was steep, a fine up to $10,000, which is hundreds of thousands of dollars today, or up to 10 years in prison, or both. Now, this wasn't outright theft. The government paid citizens for their gold at the official price of the day, $20.67 per troy ounce. People lined up exchanging their tangible, historic wealth for paper currency, told it was their patriotic duty. But here's where the story takes its most crucial turn. The playbook isn't just about the seizure, it's about what comes next. Less than a year later, in January 1934, Congress passed the Gold Reserve Act. This act officially gave the U.S. Treasury title to all the gold collected by the Fed. And then, with the stroke of a pen, Roosevelt raised the official price of gold to $35 an ounce. Let that sink in. The government forces you to sell your asset at $20.67, and then once it owns all of it, it revalues that same asset to $35. That's a nearly 70% increase in the value of the government's newly acquired reserves. It was a massive transfer of wealth from the public to the state, all done under the color of law. This devaluation of the dollar against gold let the government print billions more in paper currency, financing its programs with the confiscated purchasing power of its citizens. For the next 40 decades, it remained illegal for Americans to privately own gold bullion. That ban wasn't lifted until President George Ford signed a bill into law, with the change taking effect on December 31, 1974. An entire generation lived in a country where owning a bar of the world's most enduring monetary metal was a crime. This isn't a conspiracy theory. It's a documented chapter of American history. It's the playbook. Step 1, discredit private ownership by calling it hoarding. Step 2, use a crisis to justify seizure for the public good. Step 3, consolidate control. Step 4, revalue the asset for your own benefit. You might be thinking, that was gold. It was physical. It was a different time. They could never do that with my Bitcoin. But if you think the government has forgotten this playbook, you're mistaken. The asset has changed, but the motives are starting to look eerily familiar.
Fast forward to today. The United States government is, without question, one of the biggest Bitcoin whales in the world. But it didn't get there by mining or buying on the open market. It built its hoard the old-fashioned way, by taking it. Through years of criminal investigations and asset forfeitures, U.S. law enforcement agencies have amassed a colossal crypto fortune. It started with the famous Silk Road case, where the government seized tens of thousands of Bitcoin from the darknet marketplace. Then came the Bitfinex hack recovery, which clawed back over 94,000 Bitcoin. Another major seizure brought in over 50,000 Bitcoin connected to a Silk Road hacker. When you add it all up, public reports and blockchain analysts estimate the U.S. government has held at various times over 200,000 Bitcoin, with its current holdings still valued in the tens of billions of dollars. And that number grows with every major cybercrime bust. For years, the official policy was simple: seize it and sell it. The U.S. Marshals Service was tasked with auctioning off this seized crypto. In fact, reports indicate that between 2014 and 2023, they sold nearly 200,000 Bitcoin, often at prices that, in hindsight, seemed tragically low. This represented billions in potential value lost to taxpayers. This approach treated Bitcoin like any other seized asset: a car, a boat, a piece of jewelry, something to be liquidated for cash as quickly as possible. But the winds in Washington are changing. A fierce debate is now raging. Why, some are asking, is the U.S. government selling off a scarce digital asset with the potential to be a global store of value, especially when national debt is spiraling? Senator Cynthia Lemis has sharply questioned the Marshal Service's strategy, highlighting the massive unrealized gains forfeited by selling too early. This brings us to the policy debates that have intensified recently. A few years ago, the focus of Executive Order 14067 was on the risks of crypto, consumer protection, and heavily on researching a U.S. central bank digital currency, or CBDC. It was the posture of a government trying to get its arms around a technology it didn't fully trust. But more recently, the conversation has shifted. There are now serious proposals being debated in Congress, such as the Bitcoin Act introduced by Senator Lummis, to create a national strategic Bitcoin reserve. This is a huge pivot. The conversation is changing from how do we regulate this risk to how do we harness this asset. The government is no longer just thinking like a seller, it's starting to think like a long-term holder, a hoarder. This is where the facts of today meet the playbook of yesterday. The government has the Bitcoin. It has the historical precedent for asset consolidation, and it's beginning to show the motive. So what would it look like if the government truly decided to follow the 1933 playbook? What if the ideas being debated in the halls of power became official policy? Let's explore a hypothetical scenario, a thought experiment based on the very real trajectory we're on. Imagine news breaks of a new executive order. Let's call it the National Strategic Asset Order. This order doesn't target private citizens, not yet. It targets the government itself. The first provision is simple. The U.S. government will immediately halt all sales of forfeited Bitcoin. The auctions stop. The era of treating Bitcoin like a seized speedboat is over. The second provision is the game changer. It formally establishes the United States Strategic Bitcoin Reserve. All government-held Bitcoin, the hundreds of thousands of coins seized from criminals, are transferred to the Treasury and designated as a strategic asset, just like the gold at Fort Knox. The justification would echo the past, citing Bitcoin's fixed supply, its security, and its status as a global, non-sovereign store of value, digital gold. Now, an executive order is powerful, but Congress would be needed to make it permanent. This is where the proposed Bitcoin Act comes into our thought experiment. This hypothetical act would codify the strategic reserve into law. First, it could mandate a decentralized physical storage network with private keys stored in fragments in secure, dispersed cold storage facilities. This would be framed as protecting the reserve from a single point of failure. Second, the act could establish a minimum holding period, perhaps 20 years, unless the Bitcoin is used to pay down federal debt. This would signal to the world that this isn't a trade, it's a permanent treasury asset. And third, in a nod to crypto's own ethos, the act could mandate public proof of reserves, with the Treasury conducting quarterly reports to prove its control of the assets without exposing them. So why would they do this? There are a few reasons. On the surface, it's a fiscally prudent move. As Bitcoin appreciates, the reserve could become a significant asset on the nation's balance sheet, a backstop against inflating national debt. But the deeper motive is geopolitical. In a world where nations are de-dollarizing and central banks are buying gold at a historic pace, a strategic Bitcoin reserve becomes a powerful tool in a new kind of monetary Cold War. It's a hedge against the dollar's declining dominance and a play to control a large piece of the world's future neutral reserve asset before rivals can. This hypothetical scenario isn't a wild prediction. It's an illustration of a logical endgame. It shows how the government can move from seizure to strategic consolidation without ever touching a single Bitcoin owned by a law-abiding citizen. They wouldn't need to. By cornering the market on forfeited assets and declaring Bitcoin a national treasure, they could centralize control and influence the network in ways we are only beginning to imagine.
The obvious question in all of this is, can they replicate the final step of the 1933 playbook? Can they go from consolidating their own Bitcoin to coming after yours? Is a digital version of Executive Order 6102 even possible? The answer's complicated, and it lies in the fundamental differences between gold and Bitcoin. Gold, in 1933, was vulnerable. It's physical, bulky, and hard to hide in large amounts. More importantly, most people didn't hold their own gold. It was in bank vaults. When the government issued its order, it didn't have to go door to door. It just compelled the banks to hand over their customers' assets. The banks complied. They had no choice. Bitcoin, on the surface, seems like the polar opposite. It's digital, weightless, and borderless. $1 billion of Bitcoin can be stored in your head as a 12-word seed phrase. This is the power of self-custody. If you truly control your own private keys, no government agent can knock on your door and physically take your Bitcoin. They can't force a bank to turn it over if a bank never had it. The mantra, "not your keys, not your coins," isn't just a catchy phrase. It's the core principle of resistance against this kind of confiscation. However, it would be dangerously naive to think this makes crypto invincible. The government doesn't need to physically seize your Bitcoin to control it. The modern playbook would look very different. The primary point of attack is a word we all know: exchanges. The vast majority of crypto owners do not self-custody. They leave their Bitcoin on platforms like Coinbase, Kraken, or Binance. These centralized exchanges are the modern-day banks. They are regulated businesses. An order for them to freeze, report, or surrender customer assets would be just as effective as the order sent to banks in 1933. If you don't hold your own keys, you're holding an IOU from a company that will be forced to comply with government mandates. The second tool is surveillance. The blockchain is a public ledger. While your name isn't attached to your wallet, blockchain analysis has become terrifyingly advanced. Government agencies are experts at tracing transactions, linking wallets to exchange accounts, and de-anonymizing users. They can see where the Bitcoin is, even if they can't immediately take it. The third, and perhaps most powerful method of control, is the on- and off-ramps, the bridges connecting the crypto and fiat worlds. They can make it illegal for banks to process transactions to or from non-custodial wallets. They could force exchanges to require a special license to withdraw your own Bitcoin. They could create a whitelist of approved addresses and a blacklist of unapproved ones. If you can't cash out your Bitcoin, its utility is severely diminished. They could effectively trap your Bitcoin on-chain, turning your self-custody wallet into a digital prison. So, no, they probably won't come demanding your seed phrase. The new playbook is far more subtle and arguably more effective. It's a combination of custodial coercion, digital surveillance, and regulatory strangulation. They don't need to break down your door if they can simply make your Bitcoin unusable in the economy they control.
So where does that leave us? We're at a fascinating and frightening crossroads. We've seen the historical playbook. In 1933, the government, under the cover of crisis, consolidated the nation's primary store of value, gold, for its own strategic purposes. They changed the rules in the middle of the game and came out far richer and more powerful. Today, we see the echoes of that playbook. The U.S. government has become a Bitcoin whale, not by choice, but as a consequence of law enforcement. It's sitting on a digital treasure trove, and the internal debate has shifted from sell it to stockpile it. The scenario of a strategic Bitcoin reserve is no longer fantasy. It's a logical extension of current policy proposals. The fundamental difference, of course, is that the 1933 seizure took gold from ordinary citizens, whereas a new Bitcoin reserve would, for now, be built from the proceeds of crime. This is a critical distinction. But it doesn't change the underlying principle. The state is recognizing Bitcoin as a strategic asset and is moving to secure a dominant position. The very existence of such a reserve is a double-edged sword. On one hand, it's the ultimate validation, the most powerful government on Earth implicitly admitting Bitcoin is a legitimate store of value, a digital peer to gold. This could trigger a wave of institutional adoption, but, on the other hand, it represents a concentration of power that runs contrary to Bitcoin's entire ethos. A government that holds a significant portion of the supply can influence the market and use its regulatory power to favor its own holdings. The tools of control are subtle but powerful, coercing exchanges, tracking transactions, and policing the on- and off-ramps. The original promise of Bitcoin was to be an escape from this very system, a non-sovereign money no government could control. But what happens when the governments you were trying to escape from become the biggest players in the game? So what do you think? Is a government strategic Bitcoin reserve an inevitable and bullish step in Bitcoin's maturation? Or is it the first move in a long game to co-opt and control digital gold, just as they did with physical gold nearly a century ago? Let me know your thoughts in the comments below.